market sentiment and judging where price will go by seeing where price has previously been. My name is Dylan, and I'm going to help you guys today understand a little bit more about Forex and why price moves the way it moves. So, the other day we had that massive move on the GBP pairs. GBP, NZD, GBP, JPY, they all did the same move. You can see the market makers were moving the GBP crosses, and this is because of that certain news event. I believe it was some meeting that happened that the market makers used that to cause a distraction and move the GBP crosses as they did. So what we can see here is GBP pairs were in a consolidation for about three or 4 days. I mean, they didn't move much for 3 or 4 days. They stayed in a range of about 50 to 90 pips. GBP JPY did the same thing here. It basically bottomed out here and just consolidated right here in this zone. But what I want you to see is coming up to this big move, what happened here and why did it happen? So the consolidation that happened previous to the big move was like a spring being loaded to pop, and market makers basically were moving price up and down and basically stayed sideways for 3 or 4 days to create a sum of orders and trap an amount of short holders in this big consolidation area and trap them with one big move here, as we saw, to the upside. GBP NZD moved about 500 pips to the upside. But yeah, we can, just by seeing the daily right here, this was 1 day. Alright, just by seeing the Asian consolidation, we can tell that there was a big move about to happen. So we didn't even have to go back and look for the 3 days prior to know that that was going to happen. But what we do see here is Asian consolidation. They moved price up and down in a range of about 50 or 60 pips, about 60 or 70 pips, and it was right above the moving averages. You can see the moving averages are leveled out, and then out of nowhere, alright, actually it wasn't really out of nowhere, it was right at London Open. Okay, London Open was about right here. Market makers jolted the price down. One candle moved price 96 pips, almost 100 pips. Alright, in one candle, 100 pips. And then they took out the low 3 or 4 times. 1, 2, 3. And then in one more candle, they shifted that zone. Okay, what happened though? Market makers use this one candle to hit the stops of any short holders that were selling at this in this zone and had their stops down here. So not only did they hit the stops of any sellers, but they also induced people to sell. They induced retail traders to sell. Why is that? Alright, because in one 15-minute candle, price moved 100 pips to the downside. That's crazy. Alright, after a relentless Asian session, which most people trade, 11 hours of consolidation, one candle later they moved 100 pips. You go, holy crap, I'm a retail trader. I just go off of whatever I see and I'm gonna sell. Okay, that's what most retail traders do. You know, that's what they're taught. They're taught to trade breakouts. They're taught to trade price when it goes under the moving average. You can see the moving average, all three of them are leveled out, and price broke every single one in that one candle. Alright, price is now under the moving averages for 3 more 15-minute candles. So for 45 minutes they stayed under all three moving averages. For 45 minutes the retail traders were selling like crazy. For 45 minutes the buyers were wondering what the hell is going on because their stops were hit in one massive candle, and they're afraid to buy now because they see this massive red candle. So you have to see what's going on from the other side. Okay, if you were a market maker, how can you create a panic in the market? You can have 15, 20, 30 hours of constant consolidation, alright, like you see here, just price moving in tiny candles, and then out of the blue there's one massive candle. Okay, that's their job. These market makers use these candles to hide what's really happening, and the information that you guys are taught as retail traders, they're using it against you. Okay, you're taught to trade breakouts. Okay, you're taught to trade to go short when price is under moving averages. Okay, we're taught that as retail traders, but we're fed lies as a society. Alright, that's nothing normal. I mean, that's nothing unnormal in our society nowadays, that we're fed lies, we're fed fake news, we're fed fake food, we're fed fake trading advice, we're fed fake advice like trend lines and different trends and support and resistance, and we're fed these lies that apparently the market, you know, you can go on to a population graph. I believe I pulled one up before, and you can see head and shoulders patterns all day long on population graphs. Does that mean anything? No, it's just the way that a graph is set up. You can put trend lines all day long on certain indexes that have no meaning, and it's just the way price is set up on these graphs. It's just patterns that you see over and over, and sometimes they work out, sometimes they don't. We're not trading 50-50. We're not trading those patterns that retail traders trade. We're trading via market sentiment, and we're trading against what retail traders trade. Okay, we're trading in line with the market maker and what he's doing to manipulate price and to get traders to trade in the wrong direction. So we can see, obviously, there was a bunch of sell orders down here. Market makers induced sellers to sell, and they moved price down to here because, number one, we can see there was a massive consolidation here. Obviously, if you put a trend line here, there's going to be breakout traders trading below that trend line that they see. So there's going to be a sum of orders down here, obviously. And then what did they do? They shifted the zone. In one day, they moved 500 pips to the upside. They hit 1.83, 1.8318, 17-ish. All right, they hit here. Why? Why is that? All right, we can see the candles do not lie. All right, you guys, price action doesn't lie. These candles don't. Sorry, you guys, the QuickTime player just cut out on me. I have a horrible screen recording device, whatever. But you can see price came up, and the market makers are trying to hide their move within this candle, but we're not going to buy it. All right, this is obviously price came up to here for a reason. They're searching for sell orders now. They've exhausted all the buyers. They've exhausted their buying capacity, and now they need to consolidate and hit a zone of massive liquidity. Obviously, up here there's a zone of massive liquidity. They came up. Here is 127 pips. 127 pips they came up, and then came down to hide a 78 pip wick. All right, there's obviously something up there that they want. They want sell orders. They're searching for sell orders. And then we can see, someone asked me the other day, GBP/NZD came up, and then they had that last big spike up, right? Okay, and it was like right here, and they were like, "Yo, Dylan, should we buy?" And I'm like, "What? Why would you buy? The price just came up like 500 pips. You actually think it's going to keep going up?" That's what they want you to think, you guys. Okay? They want you to think that it's just going to keep going up forever because it went up 500 pips. You know, the candles are huge. That's what they want you to think. So, we can see after this massive candle, the tiny candles come back. Asian session, we have the session changeover, Asian session, and then price comes up again to that zone where they were before looking for liquidity. Okay, let's draw that out. Alright, remember that they came up here to look for sell orders because the buy was exhausted. Okay, now we can see they hit that zone, and I believe GBP/NZD has some massive, at least on my broker, it has some massive spread, like 10 or 14 pips. I don't know about you guys, but it came through wicks into that zone, and then 10, 15 pips above it is your spread, so obviously they're going to get any orders above that wick, that previous wick, without breaking it. And then we can see price came down 175 pips, came back up. We can see they rejected the 200 moving average, came back up, and threw a pin to it again, rejected it, 100 pips down, came back up, and then this is where they threw a set of railroad tracks. Alright, they came up and then came back down below that zone, and that's when we knew to sell, right there when they came below that zone again. And you can see soon after they crossed on the TDI, the green and the red cross, which means a shift in the zone. So we can obviously see the candle here shifted the zone that was right here. You can call that support and resistance, you can call it whatever you want, but it's the market maker shifting the zone, and it's shifting the zone away from retail traders that were induced by this long, what looked to be a long. It was a 67 pip move to the upside in 2 candles after a massive consolidation here again. So we can see price has these patterns, you guys, that once market makers hit certain areas, they exhaust price to a certain point. They look to hide their moves behind these candles to get you trading in a different direction than you should be. Okay? They want you to trade Asian consolidation. They want you to be surprised by this massive breakout. They want you to trade breakouts. They want to give you 10, 15 pips every so often for a breakout trade. Okay? If you were looking for 10, 15 pips on this Asian or this consolidation right here, you saw, alright, price is in here. Let me put my trend line here. I'm a retail trader. That's a breakout. Alright, I'm going to go for 20 pips. Okay, they gave you 20 pips, 30 pips. But does that work every time? No, it does not. They give you those trades every once in a while to keep you in the game. And we can see it over and over again, these patterns playing out. We can see the same thing on GBP, JPY. They came up, made that high, alright, threw a wick to the high, the morning star, the star pattern, whatever you want to call it, came back down, and then went down for 100 pips. Alright, came back up, threw wicks into that zone, came down 50 pips to the 50 moving average. Made the little W, came back up, broke above with a shift in the zone. But are you going to go long? No, you're not going to go long. Why? Because they are still trading off of this high. They're still trading off of it. They made the peak formation here, and they have this massive head and shoulders pattern as a characteristic of a level 3 formation. So we can expect 3 levels of drop and then a possibility of more rise. But you can see GBP-NZD was showing the entire time that it was rejecting the high. GBP-JPY was a little bit more risky to trade because it made new highs. It kept searching for liquidity at the new higher highs, but it keeps coming down and trying to form that downtrend. So obviously market makers came up to the zone that was created here and continued looking for liquidity in this, what, a 50 pip zone or so. Alright, in a 34, 35 pip zone, they made that peak formation high, and they searched for liquidity in that zone, and then they dropped the price. So you can see it's nothing new. It's the market maker and his cycle, what he does, how he manipulates price, how he manipulates people to basically do what he wants them to do. So you can see, here's a perfect example again. In the middle of level 3 here, in the middle of this big move, this consolidation, you could say that basically right here on a higher time frame, this itself would be a big consolidation area. So we can see price came down in one big candle again to induce people to sell 100 pips, okay? And notice that where it started here, it started again, okay? You could call it support and resistance. You could call it whatever you want. They're searching for liquidity. They're searching for a imbalance to move price where they want it to go. So they induce the sell in that one massive candle, and then they bring price below the 200 moving average for how long? Alright, for an hour and a half, price moved below the moving average. You could maybe even say 3.5 hours, because it really was just above there for like 15 minutes or so. But anyhow, it went below the moving average, induced people to sell. Retail traders were selling like crazy. And then look at that. Again, the trend is slow. Okay, you guys, the trend is slow with these little candles that make people go crazy. Okay, if you're in a sell here and you don't see any big candles anymore, you're waiting. If you sold here, you were induced by the market maker to sell because you saw this big candle. Think about it. You're in that trade for 8, 9, 10 hours. Even if you sold here in the middle of this move and then stayed in, alright, they took all their profit back in 9 hours. In 9 hours, they took what they gave in 15 minutes. Okay, because that's the real trend. The real trend is slow, but it's steady, and it's painstakingly slow for the retail trader, especially if you sold and you're watching your equity slowly dwindle down, or you over risked your account and you just watch your account slowly blow. So that's basically what I wanted to touch up on, you guys. Just market sentiment and what it is, how you can kind of see from the other side of the screen, not what 95% are seeing. Because what do you see the 95% winning? No, obviously you don't. You have to think like the small percentage that are winning. So I want to thank you guys for tuning in, and just have a great day. Thank you guys.